The chairman and CEO of the Blackstone Group, Steve Schwarzman. Steve, good to see you.
Good to see you,
Thank
Maria.
you so much for joining us. I want to kick this conversation off with something that you wrote. Now it's got to be about a year ago, or at least 8 months ago. You wrote an op-ed on liquidity, and you were telling the world in this op-ed that if we do see markets go awry, there's a real threat that we're not going to have the liquidity because of regulation. Talk to us about that. Is that what we're seeing right now?
Well, that's just part of it. There are a lot of things going on, but clearly the regulators under the Dodd-Frank provisions have reduced liquidity in the activities that banks can be in. So in certain bond markets, for example, there's absolutely no inventories being kept by what used to be dealers. That leads to prices gapping. And it seemed to me very logical that, when you have a lot more sellers than buyers, if you have an uncertain time, that you'll get a very adverse outcome. And it's one of many factors that regulation has affected that don't end up working.
Yeah. We were talking about this earlier in the show with Josh Friedman from Canyon Partners, who basically made the point, look, when you see a market going down and you want to get out of that market, you sell what you can sell. And that means you sell where there's liquidity. So if you don't have the liquidity, it just exacerbates things.
Yes, that's right. It's a little like the Chinese putting in circuit breakers and everybody trying to get out in the first 19 minutes. You create bigger problems than you might have had.
I'm glad you mentioned China. I want to talk to you about China. And, of course, we're going to talk about the Schwarzman Scholars in China, because you've done an unbelievable thing with this scholarship program. But first, let me get your take on what's going on in China in terms of the broad economy. We saw growth numbers the other day of, 6.9%. And yet the market is reacting to what's going on in China. Why? And are you worried?
Well, the reason the market's reacting is that it's probably lower than 6.9, but markets are really reacting in response to the Chinese stock market and the way the government handled those issues, first providing too much margin debt, running it up, and then when it was collapsing, trying to unsuccessfully stabilize it, and then coming back a few months later with another type of program that didn't work with circuit breakers. So that lack of effective policy and implementation really unnerved global investors, and something similar happened with the currency management, and where they reversed course after they said they were going to weaken it. All of a sudden, a few days later, they said, well, we're changing our mind. So because financial people are judging financial phenomena, and China was found lacking, that really unnerved people. The basic economy of China is of course weaker than it was, but it's got some real strong points. The service economy is developing. The consumer economy is developing. And they hired 14.4 million people last year in China, more than they hired when the economy was growing faster.
Wow.
Because this is in services. So that part of the economy looks like it's doing okay. The part that involves infrastructure, building, steel, coal, that is doing quite poorly. And so when somebody decides to cover China and sees that there are some empty buildings and that there's overcapacity and that companies aren't earning as much in certain industries or losing money, or they're creating some bad debts as a result of that, without looking at the whole picture, you come to a very negative conclusion. And it's really more an issue of confidence. If China settles to be a 5% growing service economy, there are a lot worse things that can happen. But the people who are affected, whether they're selling commodities, those emerging markets countries, plus countries like Canada, for example, that sells, their growth rates go down. And so China has an enormous impact on the world, and it's going through a change where some parts are good and some parts aren't so good, but the parts that aren't so good also have an impact outside of China.
Because for the longest time, China was the growth story for companies everywhere.
Yes.
People wanted to be in on that 1.3 billion person population to sell their goods there. Let me get your take on what's going on with oil, because there are real knock-on effects in terms of what's happening. I know you've been a big investor here, and when you see certain companies in the shale industry facing $27.41 a barrel oil, it's forcing them to either close shop, go bankrupt, lay off people. Is this an opportunity when you look at where we are, or are we looking at a fundamental change in the energy market?
Well, what we're looking at is an imbalance of supply and demand. The demand for oil actually has been pretty good. It grows, you know, somewhere 1.5% to 2% a year. It's a tiny bit slower right now, but that kind of range. The problem and the reason for this huge decrease in oil price is that there was more production. That production basically came from the U.S. Through the technology and the innovation of America, with millions more barrels created a year by the Americans. And this tipped the supply-demand balance and drove the price of oil down from 115 to 27. Now, over time, you know, consumption will continue to grow, and supply will come in line. And it all depends whose ox is gored on this one. Is it the American shale producers? Capital budgets of almost every oil producer in the world are being savaged.
Cut big time.
Big time.
Yeah.
And so actually what happens if you never discovered anything else, the amount of oil in the world would go down about 4% a year.
Yeah.
So if you did that for 10 years, you'd have oil in enormous shortage. Enormous shortage. So it's a very delicate supply and demand.